Welcome everyone to FX Street. It is 2 p.m. Eastern, August 1st, 2012. Welcome back one and all. Great you could join us. My name is Adam Rosen. Very happy that you could join us today. Very special thanks to FX Street. In 15 minutes from now, the Federal Open Market Committee, Federal Reserve, will announce their interest rate decision. They're expected to keep rates unchanged at the 0 to 0.25% level. They're expected to maintain the current round of stimulus, also known as Operation Twist, through the end of the year. And they're expected at this point not to initiate any further rounds of stimulus such as Quantitative Easing 3. That is what is on the books, what is expected right now. What will actually happen? Well, that's left to be seen. We'll know that in about 15 minutes. Now, what they say can have a very severe impact to the financial markets, such as the dollar that we're looking at here, as well as the stock markets, etc. By the way, if at any time, if you can't see my charts or hear my voice coming through, please let me know, and I'll be more than happy to resolve the issue. At the moment, U.S. 10-year bond, we're going to make a note right now of the financial markets to see where we are before and after the meeting. So right now, the 10-year bond yield right now pays, the 10-year bond pays 1.4865. We'll round to 148, 148% roughly. The Dow Jones Industrial Average, the volume is low. Is the volume okay for everybody? I can try to turn it up at my end. Or I'll move a little bit closer to the microphone. That might help. How's that? Is that any better? Dow Jones Industrial Average, 13,023. Okay, that's good. And the dollar Swissy currency pair, the dollar Swissy is a good barometer to judge the strength of the actual dollar. The Swissy doesn't really move that much. Dollar Swissy, 97.68 I have on my my charts here. Okay, good. So 10-year bond is 148%, 1.48%. Dow is at 13,023. Dollar Swissy 97.68. There are two scenarios. What if the Federal Reserve announces that they're going to be more? I always mix this up. Let's say they're going to be more hawkish. Now, hawkish, correct me if I'm wrong. I think I got this right. Hawkish is when we believe the Federal Reserve is more likely to raise interest rates. We have hawkish and we have dovish. Hawkish means we're more optimistic. I always mix these up. I think optimistic. I think I got them right. Hawkish means that we're more optimistic. We think the economy is improving. We think that the Federal Reserve is more likely to raise interest rates. Well, if whatever the Fed says, I mean, most of us, no, I would say all of us expect the Fed to keep rates zero. But what if their statement is, they allude to the fact that they're a little bit more hawkish, a little bit more optimistic, the economy is doing well, we think that, things are going to be even better in the future. What does that mean? It means, well, they're not going to raise interest rates today, okay? And they're not going to raise them for a long time, probably through 2014. But they're probably more likely to pull away from stimulus, meaning Operation Twist. It's probably going to end in December, but maybe even a little sooner. We're definitely not going to get QE3, Quantitative Easing 3, which is a very aggressive type of stimulus. And, well, we think things are good. If that's the case, what do we think in terms of the dollar? Well, I think the dollar will go up because the dollar moves in anticipation of higher, lower interest rates. And although the Federal Reserve would not raise interest rates today, tomorrow, or anytime soon, I think over the long term that would lead to a stronger dollar. I think most would agree with that. Now, conversely, if they're more dovish, which is I guess I was going to say pessimistic or non-aggressive. I guess maybe you're right. Is that right? Hawks, I never knew that the definition was. I think things look good. And I think that leads to a strong dollar strong U.S. dollar. I think that means that we see that the bond yields go up, which means the bonds go down because bond yields tend to move in the same direction as interest rates. And I think stocks, and maybe in the short term, stocks go down. I think that's what we see if the Fed is optimistic. If Fed is optimistic. The Fed is optimistic, strong dollar, bond yields go up, and stocks go down. Conversely, if the Fed is pessimistic, which I think is going to be the case, then I think the dollar, I don't know what the dollar does. I'll tell you why. I think bond yields go down, and stocks, I don't know. And I'll tell you why. Because if they're pessimistic, the question is, how pessimistic are they? Pessimism leads the Federal Reserve to initiate things like Operation Twist and quantitative easing. Now, if they're a little bit pessimistic, well, then, the dollar might not do anything. It might be neutral. If they're very, very pessimistic, and we say, the Federal Reserve says, you know what? Things are so bad. We're going to we're going to initiate QE3 today. That's it. We can't wait any further. We really need to do something big, and we got to do it now. Well, if that is the case, then I think that quantitative easing, obviously, over the long term, leads to a weaker dollar because it involves the printing more money, which tends to dilute the dollar. So I think very pessimistic, extreme pessimism tends to lead the dollar go down, and I think extreme pessimism might actually lead stocks to go up because stocks like quantitative easing. They like all the extra money out there. Quantitative easing involves printing more money to buy long-term treasury bonds. When you put more money into an economy, you think of it as a business from the business owner's point of view. The business owner is saying, great, every one of my customers has a little bit more money to spend now, which means I'm going to sell a little more goods and services. Beautiful. That's if we see extreme pessimism. If we see a moderate, and I honestly think we're going to see a moderate amount of pessimism, that's where the tricky thing is. The dollar, I honestly can't say. I mean, I'd like to say that the pessimism would lead the dollar to go down, but then again, I think there's to a certain degree, traders are already betting on QE3. I mean, if I were to ask all of you, there's about 30 people in the room today. If I were to ask all of you, how many, let's take a quick poll here. Okay, so please tell us, what do you think the Fed will do today? And I'll give you some easy examples. Number one, if they're very optimistic, they're going to cancel Operation Twist and tell us the economy is just fine. That's number one. Number two, we're going to say that if the Fed is moderately pessimistic, and this is my vote, by the way, I think that means that the Fed will leave Operation Twist in place and open the door for QE3. Open the door meaning they're going to say, we're watching the economy and we think it might be necessary sometime in the near future. And number three, very pessimistic. This is an unscientific poll, by the way. That's why if these answers don't seem very fair, that's why. The Fed is very negative and says QE3 is just about a certainty. Please vote in our unscientific poll. What do you think the Fed will do today? Number one, they're very optimistic. They're going to say we're canceling Operation Twist, or maybe we'll, We'll extend it for a few more months, but everything is doing just fine and no new need for anything. Number two, they're moderately pessimistic. That's my vote. The Fed's going to leave Operation Twist in place, open the door for QE3. They're going to say things are bad. It's not bad enough to deem QE3 right now or next month in September, but it's probably going to happen. And number three, things are very, very bad. We might not get QE3 today, but it's going to happen. Or we're in really, really big trouble. I vote number two. Now all countries are pretending to be strong. Do you think the Fed will show pessimism? It's a great question. I mean, this is what we're all trying to, figure out. I don't know if it brings up a great point. And by the way, as if we didn't have enough fun already, we have the Bank of England and European Central Bank tomorrow. But it's funny because I don't know if you see these countries, I don't know if they're pretending to be strong or they're hoping to be strong. This is going to be another one of my polls. Do you think that all the countries are pretending to be strong? Are they hoping to convince the rest of us that they're strong? Or are they just delusional and they believe that we are strong? We're in a strong state. I mean, the fact of the matter is the different economies have thrown enormous amounts of stimulus at the markets. We're talking about go back in the past 3 months, and there's been more. This is just what I can remember. Reserve Bank of Australia just recently reduced interest rates, although their economy has been actually doing very better than most. Reserve Bank of India, Reserve Bank of China. China reduced interest rates twice in a row, 2 consecutive times. Bank of England, quantitative easing, another round of quantitative easing. By the way, we have Fed meeting minutes. And I'm going to read these in a second. And People's Bank of India, People's Bank of China, I should say, People's Bank of India, both cut interest rates. European Central Bank cut rates below 1% for the first time ever in the ECB history. Bank of England, quantitative easing. We have so much, and we're seeing the dollar, by the way, really start to take off over here. Dollar's going up, stocks are going down. Okay, what does this tell us? Without looking, I'm going to look at the minutes in a second, but let's look at the market reaction first and try to figure out what's going on. The dollar's going up, and the stock market's going down. That tells me U.S. dollar's going up, right? The stock market is going down. Now, remember, go back to the beginning of our conversation here. What did we guess? We said that if the Fed is optimistic, we expect a strong dollar, we expect bond yield to go up, and we expect stocks to go down. That's if the dollar is strong, if the Fed is optimistic. If the Fed is pessimistic, as we always said, if the Fed is very pessimistic, we expect the dollar to go down because that would initiate more QE. We'd expect bond yields to go down and stocks to maybe go up. Well, it looks like we didn't get either extreme situation. What did we get? Okay. Let's take a look. Remember what we said in terms of the levels. Let's go back. The 10-year bond at the time was 1.48%, 140.65 to be exact. The 10-year bond yield, 147.97. So the bond yield is down a little bit. Dow Jones Industrial Average, when we started to speak today, was 13,023. Now 12,962. Stocks are down. Bond yields are down. Dollar Swissy at the time was 97.68. Now the dollar Swissy 97.92. So the immediate reaction. Bond yields down. Stocks down. Dollar up. Now, let's go back and read what the Fed said. Does the Fed tend to talk things up on the run to presidential elections? No need for those elections. The Fed is supposed to be completely independent in the U.S. It's mandated by Congress. They have a dual mandate. They're not supposed to be partisan. They're not supposed to be political at all. They're supposed to be as neutral as vanilla yogurt. They're not supposed to be Democrat or Republican. They're supposed to be neutral. Obviously, that's not really the case these days, but they're supposed to be neutral. They're supposed to be economists. Confused. I thought that when the Fed is positive, the risky assets go up and the dollar goes down. Well, it all depends. It's a great question. It all depends the context. Now, we're going to read the minutes in just a moment. When the Fed is positive, risky assets go up and the dollar goes down. First, think of the Federal Reserve in terms of the dollar, because the dollar is most directly connected to the Federal Reserve. The reason why currencies move are central banks. The reason why the dollar moves is guessing what the Federal Reserve is going to do. If the Federal Reserve is expected to raise interest rates, we expect to see a stronger dollar. If it's expected to cut interest rates, it's a weaker dollar. I mean, that's the simple ABCs of Forex markets. What the central bank is expected to do has a direct correlation to what we expect the currency to do over the long term. Think of the Federal Reserve as one big savings account. If we expect our savings account to, pay us more interest next month, we're going to put a lot more money, in our savings account and wait for that interest to come in. Can't collect interest if you don't put the money in. So we have to put the money in before they raise interest rates. If the Federal Reserve initiates more QE, quantitative easing, we expect the dollar to go down because quantitative easing prints more dollars, which means every one of our dollars has less buying power, and therefore commodity prices go up and our dollar goes down. In terms of the stock market, it's a little bit different because the stock market lives and breathes these days off stimulus. The stock market loves stimulus. The stock market loves quantitative easing because quantitative easing means that interest rates are going to stay low for a longer period of time. Every consumer is going to have more money in their bank accounts. Think of it this way also. There's more dollars in circulation. I mean, you do the simple math. If there's, let's say, I'll make up a number, $1 trillion, there's more. But let's say there's $1 trillion in all the world. And the Federal Reserve initiates QE3, and now there's $2 trillion. Okay? There's more dollars out there, which means if you run a business, you have the expectation to collect twice as many dollars. Now, you're going to raise your prices because there's going to be more demand there. And as a result, that leads to inflation. Quantitative easing leads to inflation. Quantitative easing leads to high oil prices, high commodity prices, food prices going up, gold prices going up, everything inflationary. Quantitative easing equals inflation. That's what it causes. But we want inflation in a good way. We want the good inflation. Good inflation is that if we run a business and we're making a lot of money, we have a lot of customers, we can afford to raise our prices, everybody's coming in with a lot more money, there's more customers coming in, that leads to inflation. That's the reason why we have quantitative easing. That's the reason also why we have low interest rates. Count Draghi. Let's look in the minutes. In terms of the stock market, and think about the bond market, very similar to the stock market, but the stock market the bond market is very similar to the dollar in terms of the yield. Bond yields go up when the dollar goes up. Bond yields go down when the dollar goes down. But over the long term. But stocks benefit from quantitative easing. So stocks will go up. Not everything happens at the same time. Think of it this way. Federal Reserve initiates quantitative easing, zero interest rate policy, lots and lots of stimulus. Companies start to make money. They start to make money. They hire more people, and they're selling a lot of goods and services. Their stock prices go up. Their price-to-earning ratios go up. Stock prices go up. Eventually, those higher stock prices and eventually those higher corporate earnings lead to inflation. Then, eventually, the Federal Reserve will say, hey, there's inflation. Let's raise interest rates. As they raise interest rates, bond yields will go up. bond yields will actually go up in conjunction with stock prices to compete for those investment dollars. But as we see inflation, then we start to see interest rates go up. Interest rates are usually the last thing to move. Interest rates start to go up, and as interest rates go up to 5%, where they were, 5.25%, then the economy starts to slow. Then corporate earnings start to slow, stock prices start to go down. Only afterwards that we have all of this evidence that the economy is slowing, then the Federal Reserve says, oh, wait, we just realized the economy is slowing down, let's reduce interest rates. So not everything happens at the exact same time. Let's take a look at the minutes. I also want to get to your questions as well. These are from the recent minutes on the Dow Jones News Tape. Federal Reserve to keep, but Fed funds range unchanged 0 to 0.25%. That's as expected. Voted 11-1 for Fed funds rate action. No surprise there. Richmond Fed President loan dissent. I don't know what he wanted to do. To raise interest rates, I have no idea. Economic activity decelerated somewhat in the first half of 2012. Growth in employment has been slow. Unemployment elevated. Business investment continues to advance. Household spending rising at a slower pace. Household sector remains depressed. All of these, by the way, these are not just headlines. This is what's telling us what to pay attention to in the next 6 weeks. In the next 6 weeks, we have another Federal Reserve meeting, but before then, we have a lot of other numbers. Unemployment claims, and we have retail sales and new home sales and all that other stuff. This is the magic of what the Federal Reserve gives us. They're now telling us, hey, economic activity has decelerated somewhat in the first half of 2012. Okay, so they're pretty pessimistic, moderately pessimistic. Now, they're telling us what specifically. Growth in employment has been slow. This is why they get paid the big bucks. Growth in employment has been slow, unemployment elevated. So they are looking for signs of improvement in employment. This is what the Federal Reserve is watching. Business investment continues to advance, so there is good news. Business investment, it continues to advance. Household spending rising at a slower pace. We like to slower pace. Household spending, we want to see that rise at a faster pace. Housing sector remains depressed. Housing sector remains depressed. Inflation has declined, reflecting lower energy prices. Inflation declined, lower energy prices, and this makes me nervous, and I'll tell you why. Remind me why I'm nervous. Long-term inflation expectations remain stable. Long-term inflation expectations stable. Unemployment to decline only slowly. Again, pretty pessimistic. Global financial strains pose significant risks to outlook. Global equals significant. And when we're saying global, we don't need to guess what they mean. They're talking about Greece and Spain and Italy and a lot of the other troubled economies. See medium-term inflation at or below target. Inflation is a really big deal. Medium inflation at or below targets. Again, makes me more nervous. Expect to maintain highly accommodative stance-share policy. Expect to maintain highly accommodative. I'm spelling this wrong, but you get the idea. Exceptionally low rates at least through late 2014. Low rates through late 2014. The difference is in the past, they would argue maybe mid-2014 or late 2014. We'll continue Operation Twist end of year, throughout the end of the year. Continue to reinvest principal payments in mortgage-backed securities. Mortgage-backed securities to continue. We'll provide additional easing as needed to promote recovery. Will provide additional easing if needed. Announces for the time being no new policy steps. Let's take a look at our notes. What does this really tell us? The employment is bad. Good news is business investment advances, but that's really the only good news. Why is business investment advancing? I don't know. Household spending spending at a slower pace. Housing sector remains depressed. Now, housing sector remains depressed. Go down to the end. Mortgage-backed securities, the reinvestment, what they're doing is they're reinvesting the money that they have into mortgage-backed securities to help prop up the housing markets. Inflation, now this is what really makes me nervous. Inflation declined, lower energy prices. What was the big criticism of quantitative easing too? Everyone jumped up and down and said, no more quantitative easing. Oil's too expensive. Food prices are too expensive. Now, they didn't talk about food because food prices are really not that cheap because of the drought conditions, the hot weather conditions in the States, or, across the Midwest. So, but they're talking about energy prices. And they're saying, don't worry, there's not a lot of inflation. They're saying, don't worry, a barrel of light sweet crude oil is only $88.86. Don't worry. And what they're telling us by don't worry is get ready for QE3. I think that's the case because the big criticism to quantitative easing too was they printed so much extra dollars, it diluted the dollar, which in turn made oil prices. Remember about 3 or 4 months ago, maybe a little more than that, every day on the news, they were talking about how expensive gasoline was, $4 a gallon, $5 a gallon all over the U.S. Oil's been down since then. Oil, let's take a look at the charts. Oil, okay, that's a great example. Okay? Oil, crude oil hit highs of $110 a barrel. Since then, and this is quantitative easing too. Everybody complained to the Fed. They said, no more quantitative easing too. They said, okay, we'll take it off the table. And oil came down. Oil goes up with quantitative easing because oil gets more expensive when they dilute the dollar. The Federal Reserve is now telling us, don't worry, look at oil, it's cheap again. Oil's on sale. In other words, maybe we can slip another quantitative easing before anybody notices. Well, I think everybody will notice. But look at all of the ways that they're trying to talk about inflation and saying that inflation is not here. Don't worry, brother. Look at the notes we typed. Inflation declined, lower energy prices. Long-term inflation expectation stable. Medium-term inflation at or below targets. All of that, every time they say inflation and energy at or below targets, I'm a little bit suspicious of the Fed these days. They're not my favorite organization lately. And I happen to think that, I don't know. I happen to think, look, you mentioned, I'll go back to the other points that everyone else has made as well, but the last one, election year, no high oil prices. But the fact of the matter is, if you were to ask the average person, what would you prefer? For oil to be $10 more expensive, a barrel of light sweet crude oil, which means maybe another, I don't know, I'm guessing, 10 or 20 cents at the gas pump? Would you prefer to pay a little bit more at the gas pump, or would you prefer to see the stock market down 2,000 points from here? Would you rather have gas in Chicago instead of $4 a gallon, $4.10 a gallon, or would you rather have $4 a gallon of gasoline and the Dow Jones Industrial Average at 9,500? It's an election year. The Federal Reserve is supposed to be completely independent, but I don't think anybody would say that they completely are. And nothing hits the average consumer more directly than the value of the 401k plan. What helps stocks? Very simply, quantitative easing, stimulus. I believe the stock market, or not the stock market, I believe that the Federal Reserve is looking for an excuse to give us more quantitative easing. I have other examples, and we've talked about this in the past, that we want more, Federal Reserve wants more quantitative easing, maybe in part because it's an election year. Not necessarily that I think Ben Bernanke, the chairman of the Federal Reserve, is going to vote for the current president. Not that at all. But I think that the current administration is placing a lot of pressure on the Federal Reserve organization to get the economy working. I mean, don't take my word for it. You watch any of these testimonies. They just have the beige book. The beige book is where the Senate, the Federal Reserve testifies in front of the Senate. And there was a senator from New York, Chuck Schumer. He told Ben Bernanke, okay. He said, literally, get to work. Ben Bernanke, get to work. Fix the economy. They happen to think that the solution is in monetary policy. I happen to disagree because interest rates are already at zero and it's not working. But the fact of the matter is the Federal Reserve as an organization, there is pressure. Democrat, Republican, left, right, doesn't matter. There's always pressure that's put on the Fed to make sure that the economy is going in the right direction in an election year. So I agree. Nobody wants to see high oil prices during an election year. But what's worse than high oil prices? A stock market that's going down a lot. And if you look at the economy, and we've put together quite a few articles that discuss the effects of quantitative easing and onto the stock market, look no further than August of last year. What happened August of last year? July, August of last year. It was actually June of last year. June 2000, I'll erase all these lines. June of 2011, what happened? Quantitative easing 2 ended. This is June. What happened to the stock market a little bit after June of last year? The stock market went from highs, the Dow Jones Special Average, 12,500 to 10,600, almost 2,000 points in just about 2 weeks. This now, we can say it's a debt ceiling crisis, the debates. We can say it's a AAA rating that we lost in the U.S., the S&P, Standard & Poor's credit rating reduction. We can say all of that was a catalyst. But the real reason why the stock market just fell apart last August was that we had quantitative easing 2 all the way up. The Federal Reserve concluded QE2. They said, don't worry, the economy is fine now. They took their foot off the gas, and the stock market fell off the cliff. That was a direct result of no more quantitative easing 2. I think the stock market now is trying to figure out, are we going to get more QE3? Or get QE3, and we'll go up. No QE3, maybe we'll go down. And nobody wants to see that move down coming into an election year. It's a very, very important factor of what we're going to see over the next 98 days or so, 97 days until the election. Let's go back to some of these questions. I don't want to miss any of them. Does the dollar weaken like it should, having, according to the federal minutes, came out 2 minutes early? They never get it exactly right. Sometimes the minutes get released a little bit early. When the Fed is thinking quantitative easing, then the dollar goes down, yes. Quantitative easing dilutes the dollar because it puts more dollars into circulation. Everyone is waiting to see what Count Draghi will do tomorrow. The European Central Bank has all of a sudden become a lot more receptive. They said for the longest amount of time, we're not going to reduce interest rates. We're worried about inflation, specifically in Germany. All of a sudden, and for the first time in European Central Bank history, the ECB reduced rates below 1% to 0.75%. More recently, European Central Bank President Draghi, Mario Draghi, 2 weeks ago or last week, that started this whole stock market run. He says, we're going to do, quote, whatever needs to be done to save the euro. Maybe they'll cut interest rates more. Maybe we'll see quantitative easing. Maybe Greece will default from the Eurozone. Maybe what most people believe what this means is that the European Central Bank is going to start buying Spanish and Italian bonds. That's why Spanish and Italian bond yields sank very, very fast. Is this QE going to public or to banks? If it's going to banks, no loans will be given to public, so no inflation. Well, quantitative easing, specifically what it is the Federal Reserve prints enormous amounts of new money to buy an enormous amount of 30-year, or not 30-year only, but long-term U.S. Treasury bonds. Treasury bonds directly affect the mortgage rates. Mortgage rates are already at, all-time lows. The lower mortgage rates are, the easier the less expensive it is for people to go out there and buy a house. Doesn't mean the banks are more likely to lend money, and I think they've come to a point. The Federal Reserve has painted themselves in the corner because rates are so low now that banks, it's very difficult for them to make money at all on a mortgage. The 30-year mortgage, where are we at, 3-something% now? So the idea, though, is that as interest rates stay as low as possible for as long as possible, it'll be less expensive to buy a house, buy a car, buy a refrigerator, any big-ticket items that you would use credit. Credit card rates will go down, although we all know that won't happen because credit card rates always go up. But money will be cheaper to borrow. It'll also de-incentivize us. Is that a word? It'll incentivize consumers not to keep your money in a savings account and not to buy bonds. The Federal Reserve is telling us, don't put your money in a savings account, you're not going to make any money. Don't buy the 10-year bond, you're not going to make any money. You want to make some money? Put your money to work. Buy a house, buy a car, buy a business, start a business, buy stocks with dividends. Do something. Put your money somewhere where it can actually work. London commentators are saying Draghi is going to disappoint the market tomorrow. You take a look at a euro-dollar chart. It's a good thing. You take a look at euro-dollar charts. Euro-dollar has been going down and then up and then down and up and down and up over the past year. Over the past year, well, go back to the beginning of this year. What has happened in the Eurozone specifically? And I know today we're focusing on the Fed, but we'll talk about Europe for a second. What's happened? The euro-dollar currency pair goes down as a result of fear in the Eurozone of Greece and Spain and defaults and debt to GDP ratios and bad stuff. Then a politician will come out and say, no, don't worry. We're going to have a meeting and we're going to have a lunch and then we're going to meet at dinner to discuss what we spoke about at lunch, and then we're going to meet the next morning for breakfast and we're going to talk more about the meeting that we had yesterday, and tomorrow we're going to schedule a meeting to discuss what we spoke about the last lunch. And then nothing happens. But you'll notice what happens, and that's literally how I could best summarize what's happened in the Eurozone over the past year. But every time the politicians come out and say, no, don't worry, we're going to have a lunch and we're going to have a meeting or we're going to discuss what we met to agree to discuss, the euro-dollar goes up because everybody thinks, well, maybe this is it. Maybe Greece will leave the Eurozone. Maybe they're going to buy a Spanish bond. Maybe they're going to do something. And the euro-dollar goes up. And then everybody sort of forgets about it because nothing's really accomplished during the lunch meetings. And then the euro-dollar goes down and the politicians say, hey, don't worry, we're going to have a meeting. We promised that we're going to meet at lunch to discuss what we met the last time we had lunch. And this time we really expect to meet about something, to discuss something significant. Well, Mario Draghi, just last week, or last week, I think, this huge day in the Eurozone, this was another lunch meeting when Mario Draghi said, don't worry, we're going to do whatever we have to do to save the Eurozone. What do I think? Zoom out on the charts. I think it was just an excuse to have a lunch. Are rising prices a consequence of inflation rather than the other way around? If there's increasing money supply, where they create debt, is that inflation? It's a great question. The difference is the way I think about this, I hope I answer your question, is that I think of good inflation and bad inflation. Good inflation is when our businesses do well and we start to sell more products and services, we have more customers, business is generally expanding. That's good inflation. Prices for computers go up when there's more consumers out there that can buy a computer, and there's just more demand than supply. Bad inflation is inflation that, generally speaking, hurts us more than helps us. Food and oil. Now, ironically or not so ironically, we're talking about the difference between inflation and core inflation. When we talk about the CPI, Consumer Price Index, it's the basket of goods and services measured on the consumer level. That includes a barrel of oil and a loaf of bread and a gallon of gasoline and a cell phone and all that other good stuff. Core inflation excludes food and energy because they're considered more volatile components of the CPI. So you take a basket of goods and services, a loaf of bread, a cell phone, a barrel of oil, and everything else, Take out food and take out oil, what do you have left? Cell phones and furniture and everything else. We want that everything else to go up, which means we want core inflation to go up. That's a healthy economy. When core inflation goes up more than regular inflation, it means that the price of furniture and cell phones and computers goes up more than inflation, including food and oil. We want food to go down and we want oil to go down because most of us consume more oil than we produce. Most of us consume more bread than we produce. Most of us are not farmers and we don't work in the oil industry. For those of us that work in the oil industry, obviously it's a different situation. So try to distinguish between good and bad inflation. Going back to your question, are rising prices a consequence of inflation rather than the other way around? I mean, which came first, the chicken or the egg? Prices go up, which is inflationary. It's inflationary pressure. As prices go up, Federal Reserve is more likely to raise interest rates. Now, what the Federal Reserve is doing with quantitative easing, it's the second part of your question, they're increasing the money supply and putting us into debt. So, think of it on a personal level. We own a house and we own a business, and the business starts to get in trouble. We might not be able to pay our mortgage payment on time. So we extend ourselves on a credit card. What's our credit card? It's our own little personal quantitative easing. Well, we take money out. We take a couple of $1,000s out of credit card and to pay our mortgage. Now our money supply has increased and our debt has increased. But the actual amount of money in our bank account has also gone up. Well, that's money supply. Is that good or bad? That's bad. We don't want to increase the money supply through debt. It's called deficit spending. We want to increase our money supply through revenues, making more money at work. So, think of it, it's no different on a national level than it is on a personal household level. We want prices to go up because people have more money to spend, but people have more money to spend because we have more revenue. We want inflation to go up when unemployment goes down. We want inflation to go up when the CPI goes up without food and energy. But when inflation goes up, including food and energy, while unemployment stays very, very high. The economic numbers, I know on the outside, especially for beginners out there, it's kind of confusing. But, it actually couldn't be, I don't want to say it couldn't be simpler, but they're so revealing. Think of the economy, the U.S. economy this way. We have more money in the supply, more money supply than ever before. Yet, we have less jobs than we've had in a long time. GDP is only at 1.5%. The economy, the engine of the economy is not running. Unemployment is still, at not record highs, but very high at 8.2%. And yet we have more money than ever, which is leading to some inflation. But the Federal Reserve has actually said, guess what? Even with all of this new money, we still don't have inflation. The market is, and this is what my biggest fear is in terms of the market is becoming immune to money. It's becoming immune to quantitative easing. When quantitative easing no longer works, then what do we have left? I only have a few seconds left. Let me get through these questions. It took us 10 minutes to go through the report. How come the market moved 2 minutes prior to the announcement? Well, they have these amazing, it takes me, sometimes a long time to get through all this. But they have amazing computer models that are, do this. I don't have time to look for the page now. If you go on Google, there are very simple web pages where you can take 2 paragraphs. You can paste them into this website and they'll compare the text. I do this sometimes. Take last meeting's minutes and take this meeting's minutes and you can compare the text. Sometimes there's only a little bit of a difference in 1 or 2 words in the text that it will highlight. This program will highlight the difference. You can take 2 paragraphs with identical words, just change 1 or 2 words, and in 1 second, that text will highlight. That's what a lot of people, I think, do, is they have these computer programs that, also the economists, they know exactly what they're looking for. They know the Federal Reserve is leaving rates unchanged at 0. They know that, we're going to keep interest rates unchanged for, until late 2014. economists know all this. I like to go back and start from the beginning because, not all of us are expert economists, right? But, for the guys out there, for the individuals out there, that watch the markets this closely, they know exactly what they're looking for. They know interest rates aren't going to change. They're looking for that one piece of, they even know where in the paragraph that word change is going to occur. Whatever happened to letting the free market work on its own? That's a great question. And I happen to agree with you, 1,000%. But if that was the case, you take it a step further, and you can say, well, maybe we should not have bailed out the auto companies, and we should not have bailed out the banks, and we should have let them fail. Say, well, no, you can't do that, because then tens of thousands of people would have lost their jobs. But tens of thousands of people already did lose their jobs anyway. But the difference is, with a free market, they would have lost their jobs. The economy would have hit that inflection point, and then they would have been rehired back, maybe 8 months after being laid off. Now we're looking at a recession or, bad economic conditions 4 years, and we're still not getting rehired. So I agree with you. I think the free market is the way to go. You let the natural forces of supply and demand reset, and I think everyone in the end benefits. European Central Bank is way, way behind the curve. Why does anyone think they're going to do something now? Because, well, I don't know necessarily if there's anything significant that they can do. They can buy Spanish debt. They can buy Italian debt. They can buy bonds with euros. But I don't know if this is going to be enough. But they've on purpose been behind the curve because the European Central Bank for a very long time has been very focused towards the inflationary pressures, especially in Germany. You can say, well, why? Because Germany is a very influential, one of the strongest economies in the Eurozone, and that Germany is also an export-driven economy. And so the price of the euro, very much, the rationale is, I'm trying to think here, if the rationale is if the European Central Bank were to cut rates to zero sooner, that would have led to an enormous amount of inflation. Now, inflation in Germany is not necessarily inflation in Portugal, and that inflation would have really crippled over the long term Germany's economy, which, does contribute a lot more towards the euro area economy than some of the smaller euro area nations. If the European Central Bank buy bonds with the euros, does this mean the euro dollar goes up or down? It's a great question. Depends who prints more money faster. It's a race, and it really is. It is. Make no mistake. These are currency wars. It's like Star Wars, but these are currency wars. Which country can reduce rates to zero faster? We've seen that race. Swiss National Bank, the Federal Reserve, they're tying. They're all at zero. But more than that, which central bank can initiate more quantitative easing? I'd say the U.S. is probably number one. Bank of England is not far behind. European Central Bank, we haven't really seen any quantitative easing yet, but definitely on the way there in that direction at least. Each time the euro goes down, their lunch gets cheaper. Well, that's a good way of looking at it. If the Eurozone prints $15 trillion and distributes $5 to $7 trillion quantitative easing to the troubled countries and some to boost economies, would that still left half to lend the U.S.? I don't know. Not necessarily. I mean, the numbers are huge. But again, I think you stumble on a good point because it really depends how they implement it. I don't know. I don't know if the right thing is to buy the bonds to keep, because, Spanish debt is a perfect example. Spanish bond yields went above 7%. Everybody got very, very nervous. So what they do, they said, we're going to buy Spanish debt to bring Spanish bond yields back below 7%. What has that done? It's only reduced the borrowing costs to small amounts for a small amount of time. Is that what's called high-frequency trading, referring to the Federal Reserve releasing the minutes and computer programs responding immediately? High-frequency trading generally infers, or high-frequency trading mostly describes computers that have been programmed to respond automatically to differing market conditions. Euro-dollar breaks its 20 simple moving average to the upside in a 5-minute chart, it'll buy. The pound-dollar breaks below its own MACD to the downside on a 3-minute chart, it sells. High-frequency trading are computers that automatically buy and sell hundreds, if not thousands of times a day, trying to make 1 penny or 2 pennies in the stock market, 1 or 2 pips in the Forex market. Is there a type of trading where we do not need to know any fundamentals? Is there a way of trading where we need fundamentals? Look, I'll tell you, I started out as a technical trader, and I really didn't like the fundamentals because it's so difficult. How do I really interpret this? But you know what? I like the fundamentals. I've really become a lot more accustomed to watching them. The fundamentals are not going to tell us buy euro-dollar 123.82. But the fundamentals will tell us which way the euro-dollar is most likely to go. So when you look at a euro-dollar chart, the fundamentals are not going to tell you what this trend line is. That's your technical analysis. The technical analysis is going to tell us the trend line, tell us where to buy and sell. The fundamental analysis is going to tell us, look, try to sell short and definitely don't buy. Fundamental analysis is a reason why I've been able to hold the euro-dollar short for a long term, and I'm still short the euro-dollar, and I still think it goes down, and I think we make new lows, and I think things get worse. Fundamental analysis tells us that, in terms of betting on sports, we look at one team versus another, and we look to see which team is, has a better training coach or has better facilities or tends to play better in the rain or in the cold weather or the hot weather. All that stuff is, if I'm going to bet on sports, I'd like to know that. The technical analysis is going to tell us specifically where to buy and where to sell. But the fundamental analysis helps tell us a great story. You could only be a technical trader. I think, if you get very good with the charts and the indicators, that certainly is the case. I use both, though. I want to know as much as I can. The more information we have, the better. Information is our weapon in trading, and I want to be fully armed. Bond yields go up, the currency's weaker. Generally speaking, bond yields go up to compete with higher stock prices. Higher stock prices go up when the economy improves. When the economy improves, we tend to see a stronger currency over the long term. Weaker euro better for negative eurozone trade balance. If the euro gets weaker, you would expect more exports and lesser imports. But the eurozone's a lot of different countries. Germany is an export-driven economy. Not really the case in a lot of other places. Hedge funds talking to markets that they want to test the interim highs of the dollar from 7.24 by Friday. I don't know that specifically, but I believe you. I think that the dollar continues up. And I think y'all, by the way, I think the dollar goes up. I think the euro goes down. I think the pound goes down. I think that the current long-term trends that we've seen emerge continue to do so. I don't foresee today as anything that has changed. I still think the dollar goes up. I still think the euro goes down. I don't see I have not seen any evidence for any change. Do you foresee the Reserve Bank of Australia reducing interest rates in the near future? Not necessarily. Their economy has been quite strong compared to the others. But I think that the RBA could reduce rates if one of two things happens. If their economy really starts to weaken, I would look to China to see for hints of Australia weakening, or if the global conditions almost all of a sudden get a lot worse. We have a negative GDP in the UK. We still have a positive GDP in the US. If the US GDP goes negative, I think things could get a lot worse. Then you would see the RBA reduce rates. If things stay the way they are, I don't think so. If things get worse, yes. What about Japan? I follow Japan probably the least out of all of the nations. It's the most difficult for me to understand. But they have been injecting more quantitative easing from what I've read. I don't expect them to intervene unless the dollar yen gets down to those historic lows that we saw. But Japan is definitely suffering their own set of economic conditions. So to recap, I'm out of time here. Federal Reserve, they kept rates unchanged at zero. We expect to keep zero rates through the end of 2014. Federal Reserve says Operation Twist is still on through the end of the year. We don't have any new stimulus now. Quantitative easing 3, not yet, but they're leaving the door open. They're definitely out there. And what I found really interesting is they really stressed the point that inflation expectations are at or below targets. Energy prices are down. In my opinion, it looks like the Federal Reserve is looking for another excuse, another reason to justify quantitative easing 3, maybe because of political pressure in an election year. The Federal Reserve are reminding us that energy prices are down, even though they're $4 a gallon of gasoline in Chicago. Even though the Federal Reserve tells us energy prices are down, I think they're just trying to say to us, hey, don't worry about quantitative easing 3. Look, energy prices are down. You have nothing to worry about. Again, I'm out of time. If you have any questions, you can always contact me directly, www.forexlounge.com. I want to thank you all very much for joining us. It's a very special thanks to FX Street. Please see the calendar. We have so much to look forward to. And, of course, don't forget, this Friday are the employment numbers. Again, we want to thank you very much for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Street.